Yeah, hi there. Well, it's December 19th, and we are in the home stretch. Things are really coming together here at the year end for the markets. It's just extraordinary. I mean, the Fed obviously put a floor under the economy by lowering rates three times. So it's strange in a sense, but it feels a little bit like 1995 from a portfolio management point of view. I mean, if you remember those days, I mean, sentiment in the market was incredibly bad. Actually, we were coming out of the savings and loans crisis. It was unclear whether we were going to double dip. The Fed was very active then, but basically put sort of the floor under the economy by lowering rates again. So we got that this year, and that was probably the biggest surprise for 2019, that we would be end of the economic cycle, which we all sort of thought we were in, but we would get interest rates going down at the end of the economic cycle. That was very surprising. So we started the year with 10-year treasuries around 3%. We bottomed at about 1.4, 1.5, when we're about at 1.8. So the environment is completely different because the competition for stocks is non-existent, from at least from an interest rate point of view and an inflation point of view. So that's really significant. Then the big news of the last couple of weeks obviously is the China trade deal. Look, my view has been all along that Trump would get something. We can argue about the substance of the so-called Phase 1 deal. Nobody really has a lot of details yet on Phase 1 because it won't be signed until January. So there are rumors and all sorts of things about the size of things like agricultural purchases. But in general terms, it's very important that we have some certainty in this trade war that's been going on now for a couple of years. So I think that's very, very positive for the market. Today we got the House voting on the new NAFTA, or as it's called now, the USMCA. This is basically a revision of the old NAFTA agreement. If you remember, the old NAFTA agreement goes all the way back to George Herbert Bush and the Clinton days. So I think it's quite significant. We have to applaud this new NAFTA agreement because if you think about the time this was negotiated, we didn't really even have an internet economy. So there are things in this trade bill that affect everything from e-commerce to obviously content that's provided within automobiles. So I think it creates a good precedence going forward that it is possible to actually have trade deals negotiated between major parties. And I think it sets a pretty good precedence for trade negotiations going forward. So, there's still a few things that need to happen with the new NAFTA or the USMCA. It needs to be approved also by the Senate, and then it has to be approved by all the various counterparts. But I think that's pretty much a done deal. So then on the GDP side, look, we clearly had a slowdown going into 2019, and there was a lot of concern that rates were rising. Obviously, the Fed has come in here, so if we look at the quarterly pace of GDP growth, our friends at ISI, Ed Hyman, who we worked with for almost 20 years, he's looking at a pace of economic growth picking up into the next year. So if we look at the quarterly annualized GDP growth rate, third quarter this year we were at 2.1. Fourth quarter we're looking at about 2%, and if we look at the next year, we could be trending up to about 2.7% by the second quarter. So the best quarters that we're looking at right now are really the second quarter and third quarter of next year before things could kind of top out again. So sets a pretty nice macro environment for economic activity, and I think that's the real surprise from what our forecasts were last year. Obviously, nobody's talking about a recession next year, and we may even have GDP growth as a tailwind rather than a headwind going into 2020. That's a massive change in economic outlook. Employment, really the report we got on December 6th, which was the November reading on non-farm payrolls. I mean, that number, 266,000, just blew everybody away. I mean, that was an incredibly strong number. If you compare that to at what run rate we were at the beginning of the year, the January number was 312,000. So, we were starting to trend between 150,000 and 200,000 jobs per month, but that November number was incredibly strong. So the momentum, at least in the employment side in the U.S. economy, continues to be very strong. There was some addition through the resolution of the GM strike. That was about 46,000 jobs, but the revisions also look very good. So, I mean, our friends in the economic world, whether it's Ed Hyman or Nancy Lazar, who are our favorites, they're all looking to strengthening employment going into next year. So we think there's all good news on the U.S. domestic economy there. So the other part of this is inflation. I mean, it's just extraordinary again. Inflation is slowing across the world. China, the latest reading on Chinese CPI is 1.4% year on year. PPI was actually down, is negative, minus 1.4. If we look at the U.S. core price deflator, that is just 1.6%. So U.S. inflation is we could argue almost below 2%. PPI, which is what the purchasing managers pay, that's up 1.3%. So, there was some worry that we would see higher prices filtering through from the tariffs. We've not seen that. A lot of that's been absorbed in the currency fluctuations between the big countries. So, and even import prices, which was the big one that we were worried about on tariffs, that's down actually 1.3% year on year. So that's all pretty extraordinary. India is probably the hottest country, and when it comes to CPI, that number year on year is 3.8%. And if we look around the world in terms of emerging market growth, we would probably look to India as one of these places that has a lot of room to grow and may pick up some of that growth that's not happening in China. So, that's something we follow quite closely. Profit margins in the U.S., I mean, it's just amazing how good things are when it comes to profit margins in U.S. companies. My colleague here, Terry Gardner, does a lot of good work on profit margins, and we saw a sort of a peaking in margins about a year ago, but guess what? Margins are accelerating again. Why is that? Wage inflation is quite tame. Interest rates are now lower, so the expense and energy prices are lower. So there is again a bid under margins. So our large companies that we tend to invest in are actually really having a good time when it comes to margins and profits. So elections, obviously the election is a big overhang. We got the impeachment out of the way today. It seems markets really don't care about any of that. I think the key point on elections is where is this all going to shake out, or is the election going to shake out in the middle? More moderate types of candidates and how that'll affect the economy. So I think it's no surprise that the stock market is acting a lot better now that Elizabeth Warren is no longer considered the front runner. So the market is watching this closely. So obviously the market does a lot better when there are market-friendly or business-friendly type candidates out there. International news. Well, we finally got some resolution in the United Kingdom. Boris Johnson won a surprisingly large majority in his parliament. That was a bit of a gamble at first, it seemed, but now he basically is full steam ahead for a Brexit deal. He has a negotiated Brexit deal out of Brussels, so there was some worry whether we were going to head towards a hard Brexit or soft Brexit. Given that Boris now has consolidated his power, it's more likely that we will get a soft Brexit, that is a Brexit deal that's negotiated with the EU. That is good news for markets and economic activity. It's also clear now that the Labour Party candidate Corbyn lost a historic amount of seats, so it looks like the opposition will have to regroup here. That's all very market positive. We've even seen some positive data out of some of the other big economies in Europe. Business sentiment in Germany has been going up. That's the ZEW or ZU data that we saw in December. That was nicely up. Even in France, that's obviously, if you follow the news, France is sort of in lockup right now because of the trade unions. The public sector trade unions are on strike. So if you're trying to catch a train or anything to do with infrastructure, it's very difficult there. But even the French data for business sentiment have picked up in November quite nicely. So there is a tone around the world that the economic activity is picking up, and a lot of that has to do really with liquidity being injected through central bank activity or quantitative easing. All of these things have a lag effect. It's typically 1 year, and we're seeing some of that filter through into the real economy now. So, we feel, based on what's happening here in the US and based on the better data that we're getting out of the international economies, quite good about the environment going into 2020. So markets, the S&P as we speak is at 3,203. That is a new high. The market is up about 29% total return. If you were more fortunate, like us, to be slightly more tilted to growth, you're up more than that. So, I was looking at our record since we started managing money. That was back in the mid-90s. Our best year ever in equities was in 1998, where we were up 38%. With a little bit of luck, we will end the year at about 33 or 34%. So, this is a pretty extraordinary year. And typically, the question is, okay, where do we go from here? Typically, if you get an exceptional year, actually the next year is also quite good. So if I tell you what happened after 1998, we had 1999, markets were up over 20% as well. Obviously, the music stopped in 2000 with negative returns for 2 years. So, but the key here is you do not want to miss the returns towards the end of a cycle. They tend to be quite high. So the setup then, if you look at the fundamentals and PE ratios and Fed funds rates comparing to the end of the cycle in the late 90s, I mean, if you remember, at the end of the 1990s bull market, which was the previous longest bull market that we ever had, we were at Fed funds at 6.5%. I mean, Fed funds today are at 1.75. So in PE ratios, if you like to follow that, the PE on the market right now is about 19 times. that compares to 30 times at the end of 2000. So, there's always a lot of talk amongst strategists about, is this an expensive market or not? I would tell you, as a stock picker and as a money manager for 25 years, my companies that I invest in are not expensive. I mean, if I look at my growth stocks, whether it's a Facebook or a Google, to any of our healthcare stocks, back in the 90s, we had to pay between 40 times earnings and in some cases 80 times earnings to buy the same kind of growth that we have today. The other big change is that our growth stocks today, most of them pay very nice dividends. So if you look at a stock like CVS or IBM they all have, or Home Depot, they pay between 2 and 4% dividend yield. That didn't used to be. We didn't have the luxury of dividend growth and dividend payments back in the late 90s. So these are all things that, as a stock picker, we feel actually quite good about what we're seeing and the opportunities that we're seeing in the market. So just a quick note on micro. We had earnings just recently out of Adobe. Adobe kind of sold off a little bit. It's one of our favorite stocks on the cloud computing side, or the SaaS side, that's software as a service. Adobe and Autodesk are our two favorites there. The earnings again were off the chart, which really shows that cloud computing and software as a service is something that's here to stay. We love companies that have virtually no competition. That's really our bulldog investment style. Adobe's one of those. Autodesk is another one. So we continue to see really good opportunities there. The other area I would highlight is healthcare. Now that the political and election cycle is becoming a little bit more clear, and the candidates that are front runners now on the Democrat side are probably a little bit less hostile to drug pricing than the ones that were leading just a month ago. You've seen quite a rally here in healthcare stocks. We continue to like that sector going into 2020. Roche is one of our big holdings there. Roche just finally closed the deal on the 16th to acquire Spark. Spark Pharmaceutical is a company that's very heavily involved in the genomics side, and to us the future of healthcare is really in the immune therapy side, and you will see a lot of news and a lot of activity coming out of companies like Roche. The other one we have there is Regeneron. So in summary, it's been a great year to be in equities, and even in bonds. It's the first year probably in several years that we've actually had a total return in bonds as well, not just collecting the coupon. So it's been an extraordinary year, and a lot of that has to do certainly with Fed action. But going into 2020, we are still quite optimistic that we'll have a decent return. We're not worried about recessions, and we're finding plenty of opportunities to invest the money. So we are looking forward to another good year. We thank you for your support, and we'll see you in the new year. Take care.